Hey traders, Gavin McMaster here from Options Trading IQ, and today I'm going to do a quick review of a covered call trade on XLU. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So covered calls are a popular options strategy used by investors to generate additional income from their stock holdings. In this video, we'll work through a recent example on XLU, as well as some other key points about covered calls. Let's get started. So some tips for covered calls before you get started. Number one is to stick with quality companies. Two, choose delta around 15 to 20 for better probabilities of the call expiring out of the money. Number three, go for around 30 days to expiration. That's probably pretty common, pretty standard. You can do shorter term if you have a bit more time to monitor them. If you have less time to monitor them, you may want to go out more to 60 to 90 days. Number four, have a plan for when and how you will adjust. Some benefits of covered calls. Well, they offer an enhanced yield in addition to the dividend. They perform well in stagnant and slightly bearish markets, and they offer some downside protection. Some of the risks of covered calls. You can still experience large losses if the stock has a big drop. You have assignment risk as well. So if the covered call goes in the money, you may have your shares called away from you, which could have tax implications. And there's opportunity cost as well. If the stock goes on a monster rally, you're going to miss out on a lot of that upside because you're limiting yourself by selling that covered call strike. You're limiting your upside. So XLU, this was entered around April 18th. You can see here the stock or the ETF bounced right off that rising 50-day moving average. And I wanted to get some exposure to defensive assets. So I thought XLU was a good opportunity for a covered call trade. This is a trade I did. I bought 100 shares and then I sold an at the money call out at the September expiration. I like to do fairly long-term covered calls because they're quite low maintenance. I can just leave them sitting there and they don't require too much management. You can see here the profit potential is about $320, $330, and that'll occur anywhere above a price of 64. And the break-even price is down just below 61. The blue line here is the profit and loss at expiration. The purple line is how the trade looks as of today, or the T+0 line. So this was April 17th, 157-day trade, and you can see if the stock stays above 64, we're going to get around a 12.5% annualized return, not including the dividend. So this would be more like about 14%, including the dividend payments that would get made during this time. You can get higher returns if you choose a more high risk underlying. This is a fairly low risk, low beta underlying, doesn't move around too much. So the returns are obviously a little bit lower, but that's exactly what I was looking for. A nice defensive play with low volatility. Fast forward a month or so and the stock has rallied to 71.27. You can see we've lost money on the call that we've sold, but we've made money on the stock. Overall, the position's up about $200 and there's about $125 in premium or profit potential remaining. So that's how much time premium is left in that call option. And that's basically how much profit we'll make between now and September. Now, in less than a month, I've made $200 and I've only got $125 in profit potential remaining. So for me, that's a closeout because I've already achieved well over 50% of the profit in much less than 50% of the trade duration. So much better to close the trade out, redeploy capital in another trade rather than waiting another 4 or 5 months for this last $125. So this is where we closed out early after just under 1 month. And you can see what the stock did there, bounced right off that 50-day moving average and had rallied up to 71. So successful trade. Obviously would have been better if we hadn't sold the call, if we had just bought the stock, the ETF, but such is life. I was pretty happy with that $200 return in a short space of time. The other thing I like to do is just to analyze when I'm deciding whether to keep the trade or not, how much profit is in the trade if I was to hold it from this point onwards. And there was only about a 5.5% profit potential in the trade. So that was a little bit low. So I thought better to close the trade out, free up that capital for other opportunities. So in conclusion, covered calls are a fantastic way to generate extra income from a stock holding while also providing some downside protection. Investors would need to weigh the pros and cons of the stock before initiating a bullish trade like a covered call. I hope you enjoyed this example on XLU. Thanks for watching and have a great day.